Central clearing is a financial market mechanism in which a central counterparty, CCP, becomes the intermediary between buyers and sellers in derivative transactions. Instead of counterparties facing each other directly, the CCP acts as the buyer to every seller and the seller to every buyer. This process significantly reduces counterparty credit risk and improves market stability. Central clearing is particularly important in derivatives markets, where interconnected exposures can create systemic risk. By standardizing settlement procedures and enforcing margin requirements, CCPs enhance transparency, liquidity, and confidence within financial markets. The program highlights central clearing as a critical post-crisis reform designed to strengthen the resilience of global financial systems. One of the primary principles of central clearing is the management of counterparty risk through margining and default procedures. Clearing members are required to post initial margin when entering contracts and variation margin as market prices fluctuate. Positions are marked to market regularly, ensuring that losses are recognized and collateralized promptly. CCPs also maintain default funds contributed by clearing members to absorb losses if a participant fails to meet obligations. These safeguards create multiple layers of financial protection that reduce contagion risk across markets. Through novation, the CCP legally replaces the original counterparties in the transaction, simplifying risk management and ensuring continuity even if one market participant defaults. Central clearing became increasingly important after the global financial crisis of 2007 to 2009 exposed weaknesses in over-the-counter derivatives markets. Prior to the crisis, many OTC derivative transactions were conducted bilaterally with limited transparency and inadequate collateral management. The collapse of major financial institutions demonstrated how interconnected derivative exposures could rapidly spread financial distress throughout the global system. Regulators responded by encouraging or mandating central clearing for standardized OTC derivatives contracts. Reforms introduced under Basel standards and other international regulatory frameworks aim to improve transparency, strengthen capital requirements, and reduce systemic risk. As a result, CCPs now play a central role in maintaining market confidence and financial stability. Despite their benefits, central counterparties themselves face significant risks because they concentrate large amounts of financial exposure. Counterparty default risk remains a major concern if multiple clearing members fail simultaneously during periods of severe market stress. Liquidity risk can arise if a CCP cannot obtain sufficient cash or collateral quickly enough to meet settlement obligations. Market risk is also substantial because extreme price movements may create losses exceeding posted margin. Operational risks such as cyberattacks, system failures, or inadequate internal controls could disrupt clearing operations. Since CCPs are systemically important institutions, weaknesses in their risk management frameworks could threaten the stability of broader financial markets and institutions globally. To address these vulnerabilities, CCPs implement comprehensive risk management practices and regulatory oversight mechanisms. Stress testing is used to evaluate whether margin levels and default funds are sufficient under extreme but plausible market scenarios. CCPs establish strict membership standards requiring clearing participants to maintain adequate financial resources and operational capabilities. Many CCPs also maintain recovery and resolution plans designed to ensure continuity during crises. Regulatory authorities closely supervise CCP activities because their failure could have severe systemic consequences. International organizations such as the Basel Committee and IOSCO have developed principles governing financial market infrastructures to promote consistent global standards for central clearing operations and risk management practices. The program emphasizes that central clearing creates both stability benefits and concentration risks within the financial system. By reducing bilateral counterparty exposures and improving transparency, CCPs contribute significantly to market resilience and investor confidence. At the same time, the concentration of risk within a few clearing institutions means that CCPs themselves must be exceptionally well managed and highly capitalized. Effective governance, robust collateral practices, liquidity management, and regulatory oversight are therefore essential components of safe clearing operations. Understanding the principles of central clearing and the risks faced by CCPs is critical for financial risk professionals because these institutions are central to modern derivatives markets and systemic risk management frameworks.